Welcome to this brand new episode of Investor's Guide. Thank you so much for tuning in. I'm Frida Souza. Grab your pen and paper. There's a lot of advice coming your way. On the show this week, we'll help a 25-year-old investor save enough to buy a home. We'll take a look at the SBI Blue Chip fund, and we'll tell you why you still shouldn't be buying gold. Let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us. Of course, we're getting some questions on Twitter, Dhirendra, about the fact that on this show, we've always had a stand on the fact that gold is not as great an investment as equity over the long term. Now, we've got one question asking us why we say that despite the fact that gold has done well over the last year. If we look at the numbers, gold has gone up about 18% in the last 1 year. But in our conversation, you said you stand by your recommendation that gold is not a great investment. So what is your response to those people who want to know why we lost out on the 18% in the last 1 year?
I don't quite understand, why gold should be looked upon as an investment. Yes, it has a history. Our financial, the organized financial mechanism or, the system that exists today is not that old as gold. Gold has been in currency and has gone up in value steadily, gradually, and not as much as well as the inflation. More so now in future. But it remains a fancied asset class. It remains a fancied asset. But that should not be a good enough reason for somebody. I understand about all of the things but gold. That's one. And because of that reason, I have a permanent, my view is that nobody should ever buy gold. Then the only reason why one should buy gold is that, you are able to take a call that it will go up. I don't understand how it will go up. And, this is revealing the numbers itself right now. The 5-year return on gold is 0, but last 1 year return is 18%. Last 3-year return is negative, a single-digit negative return. So it just doesn't make sense. I don't think and I'm always addressing investors who buy for a reason, who hold an asset for a reason, and it should match with the convenience and it should match with the saving cycle. It should be able to fulfill their needs. They should be able to achieve their goals. From that standpoint, I think gold has become a speculative investment over the last 4 or 5 years. Financialization of gold has only contributed to it.
What about those people who write into us and always ask us that if we are planning for a daughter who's getting married, we know in the next, say, 10 years or the next 15 years, and we know we're going to need a certain amount of gold for her wedding, does it then not make sense to accumulate that required amount of gold slowly through the course of her life?
Don't look at it tactically, don't speculate in gold, but the way to go about it is, buy the sovereign gold fund. The big difference is that all other forms of gold ownership will mean some kind of tax being paid in terms of, whether it be an expense ratio of a gold fund or an ETF or, if you buy the jewelry or in any pure form, you will still have some transaction cost. Here is something which will earn you, which will actually fetch you as much as the gold plus 2.75% annually, which I think is great. And over and above that, the tax efficiency, it will be treated as long-term capital gains for holding of over 3 years.
So you must remember when you listen to this advice and you write back to us, the advice you hear on the show is meant for a long-term investor. It is not meant for someone who's trying to make a quick profit. This advice will not suit you if that is your final goal. Let's take a look at our financial plan this week. We're looking at a 36-year-old who's married and has a daughter and a home loan, but all of the insurance requirements. Now, the goal here is to build a corpus of 1 crore rupees in today's value. 36-year-old Biswasa Chatterjee has written in. He's married. He tells us he'd like what is 1 crore today in 24 years, and he wants to know how to build this corpus. This is also an excellent question, David. He knows he wants an inflation-adjusted number for 1 crore rupees. How does he calculate that inflation-adjusted number? How does he know what will the value be 24, 25 years down the line?
Very hard to guess. One can only arrive at some measured guess on this. And the way the things have changed in the last 2-3 years, we had an RBI governor who was talking not in terms of reducing interest rates, but targeting inflation. Now, government has actually worked on created a task force which will be targeting inflation. So I think, our historic reference rate for inflation might be different. might be different from the future, and that future is always uncertain. But even taking a and from that standpoint, I'm confident that the future inflation in India is likely to be lower than we have had in the last 20 years. But assuming that be the same, I think it will be a reasonable guesstimate to take a good assumption, or a reasonable assumption will be about 6 to 6.5%, going by what we have had in the last 20 years.
All right, so compound your value right now by 6 to 6.5% over the next 25 years. Virendra, let's take a look at his financial details and help him achieve that goal. He makes around 1 lakh rupees a month. He pays a home loan EMI of 45,000 rupees, saves 10,000. He has a fixed deposit, a PPF, and the NPS contribution. Term insurance, health insurance, all looked after for himself and his wife, and his individual policy for his daughter. So that's fantastic. And he's been investing through SIPs. Before I get into the funds that he's in right now, the PPF, the NPS, and the fixed deposit. The fixed deposit of 5 lakhs would function fantastically as an emergency fund. Would you recommend he continues that PPF? Because I'm assuming his home loan EMI will take care of all of his tax-saving needs. Technically, he doesn't need the PPF.
If you invest 1.5 lakh rupees in PPF as compared to investing in the worst Indian tax-saving equity fund, you will earn more. So this whole noise around the volatility of equity or the riskiness of equity is meaningless. And all that you have to do is choose a fund, get onto SIP, and forget about it. Don't look at the value, and eventually compare it with what the worth of a PPF versus this. And it will not be by a modest margin. It will be by a wide margin, because 2-3 factors come into play. The regularity of investment in equity also adds significant value, assuming that the fund manager is a very mediocre one. But the fact that you are investing regularly, even with a mediocre fund, which means that that fund will actually be doing very poorly over half the time, and will be doing well half the time. And that in itself will create, will optimize your returns. So the rewards for a disciplined investment in equity is much more, and I think investors should take credit for that rather than attributing it to the fund manager. And of course, they should thank the fund company for enabling such a convenience.
Also, Virendra, let's take a look at his mutual funds. He has the ICICI Prudential Dynamic Fund, the UTI Opportunities, IDFC Premier Equity, and he wants to increase his allocation. He also has HDFC Balance in the L&T Prudence Fund set aside separately for his daughter's education. And here's his question: should he invest any extra money that he has in these funds, or should he be adding more funds to his portfolio, or should he be using his extra funds to increase his EMI and pay off his loan faster? What would you recommend he does?
If you have an equity portfolio, or a money which can be invested in equity portfolio, it should not be used for prepaying that, because the return that, the cost that you are incurring on your home loan and the return that your money will generate, which is invested, is bound to be much more on a 10-15 year basis, which is what the time period of your borrowing for the home is. So in that sense, from that standpoint, don't prepay. Carry your portfolio, that will generate more return, and the differential is yours. You are effectively borrowing cheap and earning more, but that makes it necessary that you are choosing a good fund, and you're sticking to it, and you're investing regularly. I don't see a need for prepaying that. That part I would like him to clean up his portfolio, organize it. PPF he can do without, NPS he can discontinue, or just contribute the essential 6,000 rupee every year just to maintain, or to maintain the continuity, keep the accounts live. Nothing beyond that, because equity and balance fund, a combination of that, 3-4 of them, and saving as much as he can, because his income will go up. His saving in relation to his total income is very marginal. Saving which meant for investment, and that can be increased by consolidating all his money, which is getting spread all over.
That's the advice you're getting right now. If you need anything else, you can get back in touch with us. Virendra, there's a question that's coming from Vijay Kumar. He's in his mid-40s. He has 4 dependents, and he earns 30,000 rupees a month. And he tells us, life insurance and health insurance, but recently he received a lump sum of 20 lakh rupees. He wants to invest this money in a manner that will generate a monthly income for him post his retirement. And he doesn't want to use, he tells us quite rightly, the fixed deposit, because he says it will put him in the tax bracket where he will lose a lot of money on tax from the earnings generated from fixed deposits. The other thing he should technically worry about is if he's in his mid-40s, then he has about 15 years to go before retirement, and his money would not be working most efficiently in a fixed deposit. So, what advice do you have for him? How can he use this money, 20 lakh rupees, to generate, to A, compound over the next 15 years and then generate a regular income when he retires?
No, my advice is very straightforward, and it will entirely depend on where he comes from. If he has never invested in mutual funds or any market-linked investment before, then my advice is that he should invest in our stable growth portfolio, and he should spread his money over the next 2 years. It is a sizable money, and spreading his investment over the next 2 years will, ensure that he is able to average, or he is able to reduce the possibility of any catching a market high, which can't be ruled out if you are investing this 20 lakh rupee tomorrow. So that will be eliminated. Averaging, spreading your investment in equity is, not investing at one go is very crucial for any individual investor. And you should do that, remain invested for next 10, 15 years. Maybe 2, 3 years before his retirement, he should take a stock of what it has grown up to, what is the likely consumption need, and will he be getting a pension. He should take a stock of things, and maybe even for retirees, I would say that people who get into retirement, they should still be substantially into equity, because in the coming times, if you just get very conservative, move all your money to fixed income, you will not be able to beat inflation. So that is a phase where you have sizable, if you are able to build sufficient cushion, then 2, 3 years worth of annual consumption money requirement can be moved into fixed income, and then you replenish it periodically, and rest of the money can still lie there. But that can be done only by an investor who has experienced growth of their money substantially with an equity portfolio. For other investors who have accumulated their savings in fixed income, or they're getting their gratuity, they haven't experienced market, it is nearly impossible behaviorally to attempt that.
So that's the advice you're getting, and I'm going to put up on your screen our stable growth portfolio. These are balanced funds, ideally suited for someone like yourself who doesn't want to take on too much risk, but like Virendra said, it's important to have equity in your portfolio. So stagger your investment, don't go in all at once, even if you have that 20 lakh rupees sitting in your bank account right now. Quick recap of the takeaways before we go into break. While gold is a great accessory, and it's a great gift to give your loved ones, it is not a fantastic investment. Don't count it among your investments, and that's advice for long-term investors, not for those looking to make quick returns in 6 months or in a year. Also, use your extra money to invest in mutual funds rather than paying your loan. Your home loan gives you a tax benefit, and your mutual funds are very likely to outperform the 9.5% that you're paying on your home loan right now. This week, we're looking at the SBI Blue Chip fund. Here we have a question from Pankaj. Pankaj is 24 years old, and it's such a pleasure to hear from such a young investor. Now, he says he started investing in mutual funds just this month, and he's put 1,000 rupees a month in the SBI Blue Chip fund. Now, he has now 4,000 rupees to invest, and his aim is to put together a corpus for his own wedding in the next 2 years. He wants to know if the SBI Blue Chip fund is a great fund. So we'll ask Avan to give us all of the latest numbers, and then we'll get a review from Virendra.
Thanks, Ray. This week, we take a look at one of the large cap funds, the SBI Blue Chip. The fund has had a stellar performance over the long term, but how does its performance look over the last 5 years? A closer look at its performance over the last 5 years shows that the fund has outperformed its benchmark and its category, both in the bull and the bear phases of the market. The fund was at its best in the year 2014 with a return of 48%. While the benchmark gave a negative return the following year, the fund's performance was much better with a return of 8%. In fact, you will also see that the fund's performance has been much better than the rest of its peers in its category with a return of 20% in the last 5 years. With a 5-star rating on Value Research, this fund tops the performance chart amongst its peers. So is this a must-have in your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that information. First, let's just get a review of the SBI Blue Chip fund. It's a great large cap fund. It's rated 5 stars on your website. So in terms of just being, if we review it among its peers as a large cap fund, would you say it's a good fund right now?
Yes, among large cap fund, it has made a name for its, it has been very impressive of late, and just completing 10 years and emerging as a 5-star fund. And when we look at large cap category, we have quite a few index fund as part of this. So a large cap fund must beat its bench, beat the benchmark, and most of the benchmark you are actually competing them in real. You have all the index funds, so you have to really stack up at the top because this category gets crowded by a large number of index funds, the Sensex and the Nifty. And from that apart, this fund has went about defining that what it will not do a couple of years back, and that has come in handy. Looks impressive. It's a good large cap fund to have, and it has all the variables. Last 2-3 years we have seen that it falls less and rises well.
Well, also from Pankaj's point of view, Dhirendra, so he's a first-time investor. He's only 24 years old, and he's investing for a time horizon of 2 years. So even though this is a great fund, does it really suit his purpose?
It's a conservative fund, but nobody should be investing in any equity fund for next 2 years. Just, of course, unless he thinks that, his wedding is little negotiable, it can well be 2 years, it can well be 3 years, or he can actually time it and how badly this money is needed, because he'll be putting his, a 4,000 rupee monthly contribution will amount to about 1 lakh rupees of contribution. He'll be better off with a short-term debt fund for a more predictable return, and without the possibility of any big decline. Because 2 years time frame, 3 years time frame, there is a possibility, that we are in a phase of market which turns around and you are down 10% and investing regularly. That will also be an erosion in faith of a new investor, which he will not be able to regain in his lifetime.
All right, finally, Dhirendra, your star rating for the rest of our viewers on the SBI Blue Chip Fund, where would you place it on a rating of 1 to 5?
I think it's an excellent large cap fund. I would rate it as a 5-star.
All right, so for 24-year-old Pankaj, on your screen right now is our aggressive portfolio. But remember, this is for somebody who's investing right through your life. So if you have a 30-year horizon, if you have a 2-year horizon, you shouldn't be using equity at all, because you know that you don't have enough time there to invest in equity. We have a question that's coming from another young person in our Buy a Home segment. This is 25-year-old Dinesh Ravichandran, who's written in the radio. He started investing in mutual funds 6 months ago with the goal to buy a home in 2025. He wants to know if his portfolio is on track, and he sent us the list. He has the Axis Long Term, the SBI BlackRock Micro Cap, HDFC Mid Cap Opportunities, iPro Value Discovery, Franklin Smaller Companies. Now, he's basically picking his funds based on your advice. Dhirendra, would you recommend he goes ahead and continues that portfolio?
Yes, he should, and there is a possibility that he gets lucky. He may not have to wait till 2025. And this is an excellent, it's almost like our aggressive growth portfolio with the tax saving fund added into it. He has done a good job of choosing this. He should review his portfolio every 2-3 years, not necessarily every year, but to begin with, every 2-3 years, and he's well on track, and ensuring that you stick to this plan. Don't get distracted, because what the kind of market that we are witnessing right now, it's bound to be very turbulent in coming times, and somebody getting started with a portfolio like this and witnessing a big gain in a brief period of time, which most investors have in the last 6-8 months. A lot of investors are developing great confidence in the small cap and the micro cap, and that will get a little shaky. But sticking to this plan for a 10-year period is the key, not necessarily the great performance of the funds.
Our next question comes in from Amarpal Singh. He's written in, he wants to build a corpus of 1 crore rupees in the next 5 years. Now, he tells us he can put aside 2.5 lakh rupees every month for the next little over a year, and then he can put aside 20,000 rupees a month for the remaining period. Now, he sent us a list of funds that he has. He has the Franklin India Ultra Short Term Fund. He has the Taurus Ultra Short Term Fund, the ICICI Ultra Short Term Fund, and he's put a fair amount of money in those funds as well. He wants to know, should he be moving these funds about, and how should he be sort of purposing this money so he can achieve his goal?
I would like to give him a much simpler plan, and that will also be very tax efficient, and 5-year time frame, which is the time frame we have for his house. He just might get lucky. Possible that he will be, because he has substantial contribution going into his He's investing substantial amount of money. Even just looking at the face value of what he has and what he wants to invest over the next 15 months, that itself will amount to about 60 lakhs. So his contribution is sizable. I would suggest our stable growth portfolio. If he is choosing 4 balanced funds, spreading his, even the money which is invested in the fixed income fund should move there, and that will achieve the same objective in a more tax efficient way. 30% of his money will continue to remain invested in fixed income, but it will look like, from a tax standpoint, it will look like as if you are deriving all your return from equity. That is what the tax laws in this country. So you will be able to convert your, even the gains from this fixed income fund in the form of an equity return. It will be a conservative portfolio, and 5 years from now, going by all your plan that you plan to invest 20,000 rupees a month, 15 months from now, before that 2.5 lakh rupees, and I would suggest him to redeem all his investment in fixed income fund and spread that money in invest that money in the balanced fund portfolio, stable growth portfolio, even matching with this 15-month period.
Well, another very young investor has written to us as part of our hold or sell segment. 22-year-old Paramjeet has written in. Now, he says he has both term and health insurance, but he doesn't have a specific goal in mind. He's been investing 10,000 rupees every month in the following mutual funds. He wants us to just look at his portfolio. So it's so nice to hear from a young investor. But if we look at the funds that he's picked, we'll find that they're all individually great funds. But I'm wondering whether they work together as a team and whether they work together as the best team for him. So these are the funds that he has. He has the HDFC Mid-Cap Opportunity, HDFC Balanced, Reliance Equity, Reliance Tax Saver, Reliance Retirement Fund, Quantum Long Term, and Quantum Tax Savings. Now, this sort of portfolio doesn't somehow cohesively actually look like something a 22-year-old should be holding.
You need a clear plan, and the clear plan is not very complicated. The money that you need to invest so that you can save on taxes, and the laws are very clear. The maximum that you can invest and save tax is 1.5 lakh rupees. So to the extent that you can save tax, that much money should find its way into your tax saving fund, and you already have this. You have the quantum tax saving fund. Maybe continue with that over a 4, 5 year, 10-year period. It doesn't matter. The great fund and the not so great fund, the difference is nominal, and it's very hard to guess which one it will be. So, once you have taken care of that, then depending on the time frame, and I understand that for somebody who's 22-year-old, once you have your emergency fund or something which you can, which you can lay your hands on just in case you need the money at a short notice, once you have that in place, I think 1 or 2 mid-cap funds, 1 or 2 funds from our aggressive growth portfolio, that should be good enough. And you should not have anything more. If your health insurance is taken care of, I think these are the 2-3 funds that you need, and nothing beyond that. You don't need the retirement plan. You don't need the balance fund. Ideally, somebody getting started and has never experienced market, but for somebody like you who is starting with a SIP, has understood what it is, and has all the time, and then he can well be straight onto a aggressive plan, and your returns will be substantially higher, and in a year or 2 years time frame, you will understand what you have done.
It's very simple advice that Dhirendra is giving you right now, and if you need anything else, you can get back in touch with us. Dhirendra, thank you so much for spending time with us this week and answering all of our questions. That's a wrap on Investors Guide. Email ID is at the bottom of your screen. If you need anything at all, feel free to get in touch. Thanks for